Now, this video is about something that I've noticed. Now, up until about 5 months ago, our standard trade was almost exclusively a single out-of-the-money symmetrical butterfly, and that has served us very well. It's done very well. In tough markets like we have right now, on average, it's producing anywhere from a 3 to a 7% return per month. Remarkable. In markets like we had back in 2021, where the market was just going straight up, it was returning something closer to 15 to 25% per month. Mind-blowing. And that's all with just under a 4% max drawdown. So it's proportional to how much we make per month. But this year, the max drawdown has been about 3.25% butterfly, and finally realized there was a better way to play a butterfly in this kind of market. And I mean a bear market with bear market rallies like we're experiencing now, and what may continue for quite some time, although I have some things to say about that. The thing that I noticed, and I'm very, very careful to look at my stats, the distribution of returns that we have, where things end up in the course of a day, everything that's involved with placing the trade, the risk to reward, the width of the fly, the amount of volatility, how fast the premium was growing, all of that stuff we take very close note of because we want to be able to place trades as efficiently as possible and then manage them as efficiently as possible. Now, one thing that I prided myself on the single butterfly, the single out-of-the-money symmetrical butterfly, was the amount of times and the knowledge of when trades were likely to pin or how often they would pin. Not necessarily, we didn't really know when. We just knew that if we put ourselves into a certain position, took a trade with a certain risk to reward, there was going to be a percentage of the time that we would actually pin a trade. Now, what does pinning a trade mean in the context that we're talking about? Pinning a trade in our context means that we're going to go all the way to expiration or very close to expiration, and price is going to be somewhere very close to the max potential profit of that strategy. So we're putting on butterflies, and the max potential profit is where the two short strikes are, where the butterfly meets like this. If you can place it in such a way that the price at the end of the day ends up near there, we call that a pin trade. Of course, if it hits it right on it, then you get the maximum profit. That happens very rarely to get it right on it, although I've come within a couple of cents. But typically we call a pin trade, and when we're anywhere about, 5% plus or minus the total width of the fly. So just a small area. And if we get in that area, we call that a pin. And that's where you're going to achieve something like 90% of the potential value of that butterfly. And that can be significant considering that we only take asymmetric positions. The butterflies that we put on are typically a 1 to 9 risk to reward. In other words, the debit is 1/10 the size of the total of the width of 1/2 width of the fly, because we look at width as being the width of each spread that the fly is comprised of. That comes out to approximately a 1 to 9 risk to reward ratio. So if we put on let's say that the fly is a 30 wide fly, very typical. That means that the maximum potential profit is the width of the fly minus the debit. So if we put on a fly that has 1/10 of the debit versus the width, and it's a 30 wide, that means that fly 30 wide has a maximum potential of $3,000 because it's 100 times 30 minus the debit, which is 1/10 of that, or $300. So 3,000 minus 300 would be $2,700. All right. So that fly would have the max potential of making $2,700. Now, like I said, we get within 5% either way, and we get about 90% of that. That's a pin trade. So in that case, 90% would be $2,430 or something like that. Let's say that $2,400. So about a certain number of times, and at least in the old way, we would hit that pin trade about 10 or 15% of our winners. So that means like 1 out of every 10 to 12 trades, we would hit a maximum profit. Now, there were a number of times where it didn't get exactly in the middle, but still made substantial profit, somewhere between 0 and that max. And those could be huge profits as well, up to $2,400. So that's an example. Now, that's pretty remarkable. Now, when you have one fly on, about, I would say 70% of the trades are going to be relatively small, 75% of the trades. And instead of making what that would be an 800% return. Now, most of our trades are around 125% return on that, in that order, 75% of them. And then in between there, about 20% of the trades are somewhere between 125% and 800%. So there's like a range. And what that would produce is this really nice right skewed distribution of returns, very small drawdown, great risk to reward, or very low volatility on your equity curve. And it would produce an equity curve that was kind of like a stair stepper. It would go sideways, then up, sideways, then up, sideways, then up. Never really down, just like stair step. And produce that prototypical right-skewed, long-tail return distribution, which is like the dream of what every professional trader wants in their return distribution. And most retail traders, they trade high-probability strategies, which produce exactly the opposite, a left-skewed, where the long tail is on the losing side, and then the small winners are the little bump in the middle there, the median trade. And consequently, those are generally strategies that lose. That's really the hallmark of being a retail trader, especially day traders. 98% of them lose. That's undeniable. That's what happens. So what we're doing is we're trading like a professional and getting really good results. We don't have the same win rate as the retail trader. As a matter of fact, our win rate is much lower than theirs. But our returns are orders of magnitude greater. So that's all well and good. That's our classic single out of the money symmetrical butterfly using asymmetric risk to reward. It's a fantastic strategy, super easy to trade.